Let's connect then with Vikas Khemani as well, who joins in on the show. Good morning, Vikas. And we're looking at a fairly buoyant market at hand, fueled by the kind of retail interest as well as liquidity, which seems to be a flush. What is your sense as to what the advice would be to investors at a time like this? Because clearly the participation continues to remain very robust.
Absolutely, and I think we have seen a strong sort of positive sentiment across the board. So I would say number one thing to do at this point in time is to taper down expectations. Always in markets like this, expectations run ahead, and people start expecting super normal return, and that is where I think always disappointment lies. So I think the first thing is to have taper down in expectation, and secondly, I think look at only from a medium to long term perspective, because the margin of safety in shorter term obviously has kind of narrowed down significantly. A lot of sort of positivity has been built in rightfully. So I am fully convinced about the economic recovery, earning recovery, long term story. There's no question on that. But markets tend to don't go one way, right? I mean, markets have its own way of playing out that. And that is where I think that whole greed and fear kind of thing plays out in the market. So I would say surely long-term structural trend is intact, but taper down expectation and be careful about the margin of safety.
The immediate near-term risk factors then, Vikas, is it just a sense of topping out, or are you also mindful of anything the market may be vulnerable to right now?
So I think, there could be in market always risk comes from the factor when you don't expect them, right? I mean, if I were to kind of tell you from the, I think Q1 earnings will not be definitely anywhere close to Q4, given that we had partial lockdown, but it will also be definitely better than last year's Q1. So to that extent, I think you might see a little bit of tepid earning growth in Q1, but I think that's kind of baked it. But we might, this comes always from unexpected factors. One does not know. It could come from the global factors. We've had a rally across the globe. I think that there could be something from the Fed side. So one does not know this when. But one thing is for sure that there is a euphoria building in the market. The way we have seen run-ups in the small run penny stocks, that kind of indicates you that people are right now because of fear of missing out, jumping in, and that process, valuation and quality both are kind of getting ignored or compromised. And these are the typical signs of risk getting built in the market. And one has to be very careful. And I'm again repeating, I'm not saying that I'm bearish on market. I'm not, I'm very, very constructive, positive on the overall recovery of the, earning recovery and economic cycle from a medium term to long term perspective. But one has to be mindful from the short term is what I mean.
Fair enough. Where do you feel valuations are still attractive enough, Vikas, from a longer term perspective? Financials, for example, could there be pockets there given that they've been lagging behind of late, and vis-a-vis, let's say, some of the other, slightly higher traction segments like an IT, pharma? What about financials, or where do you feel valuations are slightly better right now?
Again, I think in every sector there are pockets where you could get conviction more than the valuation. We would like to, always say where can there be disappointment on the growth aspect. I think that will be the single biggest factor where you could sort of, whenever there's a disappointment on the growth, you will see correction in the valuation. So I think the factor to watch out is whether growth is getting sort of, will you get a negative surprise on the growth factor. But from a valuation comfort perspective, I think within the financials, private sector banks are still reasonable valuation, given the great earning cycle ahead of us. Even in some of the structural thematic players, like we've talked about in the past on the manufacturing side, there are companies which are getting into a structural growth path over the next 5-7 years. And so there are many pockets of decent risk-reward ratios from a growth as well as the valuation perspective available out there. I think IT services still holds, there are a couple of pockets where you could find a reasonably good risk-reward available, including the large caps, to be very frank. So I think, you've got to be very selective, but the key vector to watch out is on the comfort on the growth side. Valuations correct only when there's a disappointment on the growth. And that's where one vector we always, or at least we've been looking for. some of these sectors like chemicals and where we feel that too much of even 3-year, 4-year earning is kind of reasonably baked in, and markets are assuming that it's going to be one way, there won't be any hiccups, but things don't work like that, right? So whenever those hiccups come, you will see pockets of corrections happening. So one has to be careful of those whenever those sort of hiccups come. So to that extent, what I was saying, that the many pockets where this froth, this sort of overvaluation or over expectation rather I would say, is getting built, and whenever there is disappointment around those expectations, you will see stocks getting corrected significantly.
How big a hiccup could the inflation number pose out to be? The fact that we've seen a 1.65% jump from the previous month as opposed to what we've delivered in May, 4.23% is what we did in April, and now we're sitting at 6.3%. Do you think that in order to try and tackle inflation, the RBI perhaps is going to change its stance, given that inflation has spiked above MPC's comfort level? What do you think is going to be RBI's action? Is it going to move on rates? Is it no more going to be accommodative stance, even though they mentioned that time and again? How do you think the RBI is going to try and tackle this big spike in inflation?
Very good question. I think, see, according to me, inflation is not, in my opinion, I think what we are seeing is the spike is because of lots of supply chain disruptions. This is not a structural in nature. Of course, you will see some inching up. It can't be what we have seen in the last 5-7 years because we had anemic economic growth. So, some amount of inflation is good. So as long as within the RBI's target, and it is not structural in nature, I don't think RBI is going to sort of change its stance, and I think we are far away from that yet. I mean, I don't think we are anywhere close to that situation. We have not even seen a decent economic recovery. We are just in the early stage of the recovery, and I do believe that there are lots of otherwise levers of inflation containment. So including energy costs coming down and many more. So an RBI before changing a stance, I think they will see, in my opinion, the overheating of the economy and sustainability of the growth. These are the two important things I think they will watch out before changing its accommodative stance on that. And I think we are quite some time away from that, unless some international development forces them to do that, which currently I don't see anywhere building up.
Sure. Okay, that's quite interesting. The other question, of course, Vikas, is always what to do with PSUs. And, I'm going to include banks here because ever since SBI's numbers, the entire PSU banking space almost got re-rated. You had a big jump up in a PNB, in a BOB, although many prefer SBI, the largest of the pack as well. And then outside of that, the rest of the PSE pack, the fact that in the last 2 months you've got the PSU index hold out just so smartly, see very good gains, and sometimes even manage to beat the Nifty's performance on a weekly basis. That entire cluster as well has been chugging along very smartly. Where is it that you stand on the entire PSU pack and of course PSBs as well?
So I think there's no doubt around, that there is huge value sort of inbuilt in most of the, PSBs and PSUs, I think, because the deep value. I mean, unfortunately, we have not been able to unlock value through reforms, but this government has at least stated intent to kind of do strategic divestment of some of them, and some of them are already in pipeline, including sort of Concor and many more, and BPCL. So, two things. One is that if you were to rate the entire basket, I think market will clearly watch out for the intent to convert into sort of action. So once I think 1 or 2 divestment happens, I think you will see probably the entire pack getting re-rated. PSBs, I think definitely there is a huge value there. They sit on a huge amount of CASA franchise, which I think any private bank would die to create that, right? But fact that they have had broken asset side, which in some sense has got repaired. So I think most of the provisioning is done, and now you will start seeing them some amount of growth coming in, which I think what we saw is happening in case of SBI. So I think you will see that playing out. There's no question. The only thing one has to be worried, I mean, there's one trade which you can sort of play from a valuation bridging perspective. But once it gets to a reasonably fair valuation zone, then one has to worry about whether they can be structural in nature. That answer I don't think will be at least yes at this point in time, because of some of the inherent nature of the management freedom and overall structure of the entity on a governance structure. So then I think, so at best I would say these things have to be played out as a trade till the time this valuation gap or some freezes out. And after that, I would always say that private sector banks would offer much better risk reward from a sustainably long perspective than some of these banks.
Vikas, wanted to get in your take as well, a little bit of a deviation, but a strategy or the secret sauce or the mantra, according to you, to get rich. We ask, pose that question to a lot of our market veterans who we interact with. So what would be your take?
Secret sauce of getting rich?
Yes. How to create wealth and compound wealth.
I think work hard. There is no shortcut in life, and keep long horizon in mind, and don't compare yourself with anyone else. There is no shortcut. So, and there's a path for everyone chalked out. I think most people make a mistake, in my opinion, comparing themselves with somebody, aligning. If somebody has made so much return, how come I have made so much, so less return, or not be giving enough sort of weightage to the hard work, preparation, knowledge. I think there's no shortcut. So I would say that investing in particular and public market investing offers a great opportunity in a democratic way to people at large to get rich, to compound their capital. And there's no good time to start, no bad time to start. You can start at any point in time. So I always believe that as long as you are focused on your objective and without getting deviation and work hard, I'm sure one can. And there will be accidents, there will be mistakes you will make. But as long as one is committed and one is ready to work hard, I'm sure one can. I mean, lots of people have created significant amount of wealth, and it is open to anyone and everyone. So I think markets do offer that opportunity to everyone. So I would say these are the few things, but I'm not rich, and I'm not a great somebody who can kind of give a lot of advice. But this is what has worked for me a little bit.
But thanks anyway for those pearls of wisdom. So Vikas, getting right back to the equity markets, then your view on how you're looking at the high beta pocket, particularly infrastructure and real estate, owing to the kind of execution challenges that they may have faced due to the pandemic. Do you think that a lot of those issues now are ironed out and that we're likely to see a spike up coming in when it comes to demand as well for real estate?
Oh yeah, I mean, if you ask me, real estate is structurally a very, very big, in a great tailwind, according to me, post RERA implementation, post whatever has happened recently on the regulatory front and the, consolidation which has happened. I think market is clearly getting consolidated. Larger, bigger player will come out and better player will come out, and create opportunity in this space. There's no denial that, real estate demand is going to be here. And COVID has only accelerated. Today, the affordability ratio is, I think, probably close to where it was in 2002-3, right? We have seen prices correcting, prices remaining stagnant for long, incomes going up. So, and we have a significant engine of job creation coming up from IT and manufacturing, and in general, all of them will have a very, very positive impact on real estate. So you are in a situation where the sector has got consolidated, demand booster is there. And this is one of the core sectors which always is very, very critical for economy. So, this is in a way, I would always said that it is very much where capital market was in 1995, post formation of SEBI, a lot of cleanup happened and, it took off. And we will see real estate probably over next 10, 15 years will create a significant amount of wealth in different ways. And hence one should look at that perspective when you look at real estate, not from a, what can happen over the next 6 months. But I have no doubt in my mind that 10 years down the line, we will have a very large, significant wealth getting created from the real estate sectors, because the business models are changing, new business models are getting created, and hence one has to keep an eye on that.
Okay. What's your take on consumption, Vikas? Discretionary in particular, autos, for example. Do you think things are going to get better, or that perhaps we'll see a prolonged impact of the second wave and the hit it's had on savings?
So I think, see, again, there's a short term and there's a medium to long term in this. Short term, yes, I think we will have Q1 getting impacted, but I'm reasonably confident that Q1, partly because of the mild lockdown or semi lockdown, we will see that impact. And like it happened last year, most of the sales kind of got caught up in Q4. We will see in Q2, Q3, Q4 getting caught up, or most companies will make up around the festive season and maybe post that. Unless we had hit some third wave, fourth wave, which nobody knows. That's a very different matter altogether, but I'm just talking in general. And one thing also one should keep in mind, India is in a phase of significant structural change in the per capita income over the next 3 to 5 years. And whenever this kind of structural change happens, non-discretionary consumption, consumption in general, goes up, but discretionary consumption has a little bit more impact. You see premiumization, you see people, sort of from a lower class migrating to middle class and middle class to upper middle class, and that pushes the consumption and premiumization. And over the next 5-7 years, we will see that trend getting only accelerated. It has been underplay for last many years, but I think it can only get accelerated with the increase in per capita income. And I think we will be surprised, in my opinion, the amount of job creation in the IT sector will happen, amount of job creation which is happening in the manufacturing side. All those will have a very, very significant positive above effect on the consumption. So, that one has to keep in mind.
Okay, so a slightly longer term story that's perhaps building out there. In terms of in terms of the kind of participation that we've seen in the markets as well, Vikas, how do you see the nature of that evolving or changing as we go ahead? Currently trending at these levels, a huge amount of retail participation, of course, that we've had. So it's not just the FI money that's been coming in, but considering that we're now at these, record levels, how do you really see that building up now from here on?
It will only go up. I mean, again, let me put my view is that I think we are, in my career of last 20-25 years, I have not seen such confluence of accelerators or growth drivers coming together. And this is one of those, in my opinion, those phases where you are seeing, your services exports picking up, manufacturing doing well, banking sector is consolidated, real estate is picking up, infrastructure is picking up. And all of coming together will put India into a reasonably accelerated growth trajectory, and which will have a very, very solid impact on the corporate earning. So we are in for a great time ahead. There's no question on that. And I think if we look at the participation of the Indian population, the equity is still below, way below global standard, and where India could also be, right? And especially given the alternative avenues in the fixed income, which has been tremendously sort of going down. So you will see that also kind of pushing money towards equities, and I think it is only going to go up, according to me. Once people get settled down around COVID and its worries, you will see much more accelerated flow coming through. From the international market, again, I feel that there is no market which offers India kind of characteristics right now. And we will see only accelerated flows coming from FPIs as well as FDIs. So I mean, I'm quite optimistic on the both flows, and continue to believe that we will be in a decent liquidity scenario for the markets in medium term to long term.
Right. Great to have you on the show, Vikas. Thanks as always for taking the time out.
Pleasure chatting with you guys.